Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. Over the next 22 minutes rather, we'll talk about some key aspects of mutual funds. We'll talk about an ETF which has opened today. The NFO is open today until July 18th, and it is the ICICI Prudential Nifty Oil and Gas ETF. And what kind of investors should invest in such an exchange-traded fund? The advantages, the disadvantages thereof. First, with an ICICI Prudential AMC representative, and then, of course, getting an advisor as well. Chintan Haria, Principal Investment Strategy at ICICI Prudential AMC, joins us right now on the show. Chintan, it's been a while, but good having you. Thanks for taking the time out. Hope all is well.
Yes, all good, Neeraj. I think markets have been moving quite fast. So, yeah, it's been a while, but it's been a good while.
Yeah, most certainly. It's been a good while. What prompts this new ETF? I know you guys a lot of times take decisions or at times launch schemes when sometimes they are out of favor, but that is where the buck might be moving. Now, what prompts this particular NFO?
So fair enough. If we look at India for the last 30 years, the growth has predominantly been in services. And now we are clearly moving in a direction wherein the manufacturing pickup pace is happening. Our energy intensity is going to increase meaningfully, and with that objective in mind, on the active side, we've just launched the ICICI Prudential Energy Opportunities Fund, which goes on from it is going on, and on the passive side, the oil and gas ETF is something like you mentioned we are launching. So that's a space which has also garnered a lot of capex. I think in the last 5 years of the 111 lakh crore of capex which has happened, energy has accounted for almost 24% or close to 26 lakh crore of it. So with that thought in mind, we really believe that energy, which otherwise does not represent a very large part of a client's portfolio or an investor's portfolio today, given that last 10 to 12 years, last 2-3 years, yes, energy has performed, but otherwise it's come out of a 10 to 12 year consolidation. And as an addition to our existing wide portfolio of ETFs, we felt that the ICICI Prudential Oil and Gas ETF is a good time to launch right now, given the relative undervaluation versus the broader benchmarks and also the under ownership in the investor's portfolio.
In some sense, an ETF would be a passive strategy, and correct me where I'm wrong, Chintan, but what kind of investors in general should go in for a passive fund versus an active strategy, part one? And part two, because it's a thematic fund, what kind of investors you reckon should opt for the NFO of the kind that you've launched today?
So I think India is moving in a direction wherein it's not either passive or active, it's both. And we are seeing that increasingly. It depends on, of course, who the advisor is, what kind of an asset allocation plan the advisor is creating for the investor. But we're increasingly seeing active and passive both finding a way in the investor's portfolio. And today, the primary reason for that is both in active and passive, you have enough options to curate a portfolio based on your objectives. Earlier in passive, of course, there were hardly any options on the sectoral or thematic side. And even in the active, we had only broad sectors like technology or banking. So today, with the wider gamut of sectors and themes available, both in active and passive, it is easy to create a portfolio. So pretty much all kinds of investors we are seeing getting interested. It's more about the education also. I think thanks to your medium, we have done a lot of shows wherein we've discussed about ETFs and passives also. And active anyways is known, and there are advisors who are actively creating a portfolio out of active. So a mix of both is what we believe is happening, and that will continue, much like how a mix of everything as far as financialization of India is concerned is going on right now in the markets.
Okay. Okay. What again? What kind of investors and what are the kind of returns that can be expected from a portfolio like this? When you're talking about India's investment in energy security and the kind of growth that might come in, are there either, I mean, I don't know, either back-tested returns for a strategy like this, or these need not necessarily be back-tested because they're not factor, but any thoughts about what's the kind of, say, compounded annual growth return could come in from an investment into something like this?
So clearly, these are companies which have had a longer history in the markets. They are energy intensive or capex intensive, I should say. many of them belonging to the government sector as well. And as far as the type of investors who could look to invest in a particular portfolio like the oil and gas ETF, those who already have an existing equity bucket in the last 5 6 years, of course, India has seen massive investments by Indians coming into equity markets. And by virtue of that, they already have a certain portfolio curated. I believe a large part of the investors may find that their investments to this particular sector, which is oil and gas, may be a little less than what is warranted, given the undervaluation, under ownership of this sector, plus the growth prospects of this sector, given that in the next 5 to 6 years of the growth that is expected in oil demand globally, one third or about 1.2 million barrels per day is going to come from India. So India is going to be 33% driving force as far as global oil demand is concerned. And as far as gas is also concerned, we believe that the growth of the entire gas ecosystem in India is going to be meaningful. So at this juncture, where investors are already invested in equity, if they're looking at investing more money as a diversification plus a theme which has upside potential based on the capex which is happening in that theme, and the fact that these companies have been there for a long time, and arguably they are companies which cannot be replaced or recreated easily. They warrant a portfolio position as far as investors are concerned, which is probably much larger than what is existing in their portfolio. And hence, we believe that this is a good time for investors to look at it. Across the board, all the investors who already have an investment in equities can look to add this particular ETF in their portfolio.
Got it. Okay. Chintan, just broadly wondering, are you a bit skittish or on the prospects of the markets? I know timing a market is always difficult, but just trying to understand whether an investor should try and choose a lump sum method right now, or an SIP method right now, or for that matter, try and send on a bit of a cash because the markets look a bit stretched as per some people. I would love to understand what's the thought process at ICICI Prudential AMC or of yours personally.
So if we look at markets, of course, my career started in October 2005, and probably markets were 1/8 of what they were today, and they were at an all-time high. So I think the belief should be in India's growth, and if you believe in India's growth and you have time on your side, whenever you invest in equities, you need to have a 5 year time horizon. If you have a time on your side, then select the products properly, and you should be, doing okay. The important aspect in current markets, which have seen a 5 year significant or a 4 year bull run, is that you probably avoid those sectors which are expensive, those themes which are expensive, overowned, and something which is probably underowned, and where valuations are in your favor. You need to switch on to that. And with that aspect in mind, investors should definitely relook closely at their portfolio rebalancing, because now is the time where, with market cap to GDP of 150%, close to that, it is going to be tricky markets in the next couple of years, where the expectation of returns should be moderated. At the same time, no one is questioning India's growth. So it is a situation wherein we need to be in equities, but we need to be in equities in the right manner. And that's where rebalancing towards the cheaper aspect of the market, where the downside protection can be meaningful, at the same time where upside capture can be possible, should be your own aim when you're rebalancing your portfolio. So no one knows the markets, no one can predict the markets. But one thing we can be sure is that we are a $4 trillion economy moving towards $10 trillion in the next 8 to 10 years, maybe slightly more. But to capture that upside, we need to have time on our hands. So if you do have time on your hand, remain invested, but remain invested in the space where you have more comfort in terms of valuation, and where the ownership is also lesser compared to the broader markets. Thank you.
Got it. No, okay, just one more question therefore. And it stems from the perspective of this ETF and even otherwise. Could it well be, Chintan, that markets, as you said, could get tricky, but stay range bound, steady? Maybe there's a time correction as well. But within that, individual pockets could do well. So therefore, the Nifty may stay flattish, but the oil and gas index may actually do really well over a 12 to 18 to 24-month period. Could that happen?
So that's possible, wherein we see certain sectors, it's like a relay race, wherein certain sectors do better than the other, while the broader market remains where it is. Plus the fact with the SIP book of 20,000 crores and pension fund money, plus the general optimism and a larger base of India coming into the equity markets, there is no significant risk to the markets of a very sharp fall unless there is a global event which you and I cannot predict. And to that extent, where we believe in much steadier markets, which we've already seen in 2008 when they sold 5% of their holding in India, which is the FIs, we fell by 56% because the domestic market did not exist in a meaningful way. Today, the domestic institutional investors own more than the foreign institutional investors in India. I think we domestic institutions own 21%, foreign institutions own about 18.5%. So even in 2021-22, when we saw the sharp fall leading up to June 22, the extent was same as 2008 in terms of foreigners selling 5% of their India holdings, close to 3 lakh crores in the October 2021 to June 2022 period. But the fall was less than 10% in Nifty. So I think the fact that we have a good holding by the domestics, plus the fact that there is an SIP book to support it, and let's not forget the balance advantage funds, which whenever the markets fall are going to buy. So there is a support in the markets, but we should not ignore valuations within the pockets of the market which exist. And like you rightly mentioned, we are going to see probably some amount of relay and churn happening, maybe towards the defensive, some sectors like maybe IT possibly, if they start to do well, but we do not know because IT is linked to the US cycle, and what's happening in US is difficult to predict.
Okay, Chintan, we wish you all the best for this NFO and more, and thanks for taking the time out and being with us and giving us some idea about the kind of investors that should look at a product like this.
Thank you so much. It's always a pleasure. Thank you.
The pleasure was ours. Bring in on the show Rushabh Desai, founder of Rupee with Rushabh Investment Services. Rushabh, always good having you. Today, no different. Thanks for taking the time out. I'd love to ask you, Rushabh, the most often repeated answer to a question is, should one invest in this NFO? And the answer is a no, because NFOs may not necessarily be the best vehicle. It's an interesting product or interesting timing of launching an NFO of this ETF, oil and gas ETF that ICICI PRU has come out with. Any thoughts on this particular product?
Neeraj, first of all, thanks so much for having me on the show. It's always a pleasure to be on your show.
Thank you.
See, since markets are positive, everything is positive, the growth is positive. Let's talk a little bit of positive of this ETF. I was listening to what Chintan had to say earlier, and I do agree with certain point what he made. That first of all, that the valuation is supporting the oil and gas segment. The valuations are quite reasonable. If I minus Reliance Industries, then the valuation of the oil and gas index is quite reasonable today, which clearly says that over the next few years there can be a good upside opportunity in this sector. As he correctly mentioned that manufacturing is picking up, and there is a huge political push in the manufacturing and defense space. And particularly these two sectors will require a lot of energy consumption, oil and gas consumption. So looking at the population also of our country, which is increasing day by day, and the increase in the consumption, I think that over the next a few years, the oil and gas sector can do really well. This is number one. But at the same time, let's not forget that this is a cyclical product. Since this is a sectorial product, it is going to be very cyclical. So timing the entry and exit is going to be very important. And if I compare this product, see this product is a little bit inclined towards large caps. If I compare this product to the traditional Nifty 500 TRI index, there is not much of a difference actually. If you see the returns over the past 5 years or 10 years, oil and gas index has given only 1% higher returns. If I take a little bit of a more longer time horizon, there has been a negligible difference between the oil and gas index and the Nifty 500 TRI index. So if you ask me personally, I wouldn't go for the oil and gas ETF. I think the FlexiCap active FlexiCap strategy or the FlexiCap route is much better. As we speak, around 5 to 10% of FlexiCap funds are investing in the energy sector. Also, this might be a medium-term upside opportunity, because also let's not forget that sooner or later the world and India will transition into a cleaner energy. Of course, not now, because we are still an emerging economy and it will take time. But I feel sooner or later, the oil and gas segment will see a little bit of saturation and downside. So I see more opportunity in the emerging or the cleaner energy pockets going forward, Neeraj.
Okay, so leave out the Energy NFO is what Rushabh Desai is suggesting, because there are other options available. At the stage of the market that we are at, Rushabh, should investors consider broad market index funds by virtue of the variety that they bring to the table, as along with the fact that it is they also offer diversification?
Absolutely, Neeraj. I think this is a great time to look into index funds because there have been so many active products which have unfortunately underperformed today, right? Whether it is in mid caps, large caps, small caps, flexi caps, etc. But you know, index funds needs to be looked in certain pockets. Especially, I feel that looking at the number of funds which have underperformed in the large cap space, I think index funds can replace the large cap funds. So probably going for traditional index funds like Nifty 50, Sensex plans, or even the matter of fact, smart beta index funds can do really well. Smart beta products like say mid and small cap 400 or mid cap momentum have really proved their track record, in terms of delivering higher returns than the traditional benchmark. But I still feel there is a lot of potential in the active mid cap and small cap side. So probably a combination of active and passive would do great in one's portfolio.
Okay, okay, fair call. Rishabh, I have maybe we can try and take the topic of risk-adjusted returns and whether they help you identify the right fund. But I would first like to take a couple of queries that have come in, Rishabh, from our viewers, just to get some of those questions answered. And we'll get the queries up on your screen in just moments from now. But remember, variety of names. So first, for example, is a query from a gentleman called Srinivas. Srinivas is 50 years of age. Srinivas's goal is a retirement fund. He says, my father had a retirement corpus of 25 lakhs to invest in different instruments. What should the strategy be? Can you name a few funds? Rishabh, would you be able to help out Srinivas?
So I'm assuming that the person retires at the age of 60. So the investor has good amount of 10 years down the line. But keeping his age in place, I think I wouldn't go too much in the mid and small cap categories and funds. I think sticking with flexi cap funds, 3 or 4 good flexi cap funds diversified across different AMCs and different styles, growth and value combined, I think that should do the job for the next 10 years. Once he reaches the age of 60, I think trimming down the risk probably to balance advantage funds, because see, let's not forget that we are living longer. Our health expectancy is going to be a little longer. Our healthcare is quite nice. So I think assuming he lives till the age of 85, and to beat inflation is very tricky now. Fixed income has become quite challenging to give inflation beating returns. So I think once he turns 60, I think trimming down the pure equity and venturing into balance advantage funds should do the job. So for the first 10 years till 60, flexi cap funds, and after 60, balance advantage funds should do the job.
Illustrative examples, Rishabh. These need not be exhaustive. These need not be the only funds that you like, but any illustrative examples?
Parag Parikh Flexi Cap Fund, something is what I really like. I'll give you 4 funds in the equity side. So one is Parag Parikh Flexi Cap Fund. Second is the Franklin India Flexi Cap Fund. These are tilted towards value. Now tilting towards growth is Kotak Flexi Cap Fund and DSP Flexi Cap Fund. So probably equal allocation in these 4 funds should do the job.
Okay, Srinivas, I hope you got your answer, both in terms of the strategy to be adopted and the funds which you can use. Srinivas, if you have access to an advisor, I would urge that you do that as well. If not, I'm guessing some of these answers will have hopefully helped you. Please do monitor the funds regularly. No need to change them very, very recurringly, but keep on monitoring them for the performance and the outlook over 6 months to 1 year to 2 years in case there's a change required. Okay. The second query, Rishabh, is from, well, I'm going the other end, a very young chap, Harsh, age 20 years. The goal is lump sum returns. Harsh would like to invest 2,000 rupees as an SIP in a few funds for a time horizon of 40 years. Okay, Rishabh, well, he's got a query. 40 years is his time horizon. Can you recommend a few funds to start building the portfolio?
Neeraj, when I was 20, I don't think I was thinking about investing at this point of time. And 40 years seems to be really mouth-watering. So I can't even imagine the compounding what he will make at the end of 40 years. So that's, first of all, congratulations to him that, he's starting his investment journey at a tender age of 20, and his thought process is so clear. See, no amount is small when it comes to SIP. I think if you want to fill a bucket, it's like, drop by drop, you fill up the bucket. I think that's the right way to go ahead. This is what I'm thinking, because he is very young and he's starting his investment journey for the first time. I would suggest him to go for a traditional index fund like Nifty 500 fund. It gives a flavor of everything into it. Around 65-70% is into large caps, around 15-20% is into mid caps, and the rest is into small caps. So I think to start, go with Nifty 500 index fund. Try and taste, how equity works, or for a couple of years, and then venture into a little bit of an aggressive products. Because what happens is that, any which ways, the valuations in the mid and small caps are quite high. Although he's following a SIP methodology, we don't want him to be disappointed and completely venture out of the equity segment. So starting with Nifty 500 index fund should do the job. And then once he gets a flavor of equity, of how equity as an asset class works, how the volatility works, then he can create a proper portfolio and venture into mid and small caps.
Okay. Rishabh, again, sorry, maybe a repeat question, but could it be an active mix of actives and passives?
Neeraj, because it's just 2,000 rupees per month. Once he increases his amount, then venturing into active products will be much better, because the amount is quite less. So just starting with Nifty 500 index fund should do the job. Then probably he can venture into active funds.
Okay, and Rishabh, just one more follow-up query. When should the rebalancing be thought of? Because the person is wanting a lump sum. He's got a 40-year time frame, yes, but the starting sum is not very high. So should he look to build on as soon as 6 months are over or 1 year are over? Should he do a step-up SIP? What would you recommend?
A step-up SIP would be great. On an average, anywhere between 10 to 20% annual top-up is recommended. Either he can top up in the Nifty 500 for a year or two, or else if he's planning to step up every year, then venturing into other products also makes sense. See, reviewing portfolio very regularly is not the wise thing to do. What I mean to say very regularly means like every 3 months or 6 months may not be the right approach. Once in a year is very good, because equities as an asset class will have pockets of outperformance and underperformance, and so will the funds. Funds will have good times and bad times, especially active funds. So reviewing once a year is fine. Rebalancing, I don't think rebalancing should be considered right now. Probably once he has a proper portfolio in place, and depending on his risk, how his risk is panning out to be in the portfolio, say after 6-7 years, if his original allocation towards mid and small cap, say, is 50%, and if that allocation increases substantially to, say, probably 65-70%, then rebalancing can be done. But again, rebalancing should not be done very frequently, because ultimately it breaks the compounding process.
Okay, Rishabh, great having you as always. Thanks for all of that wisdom. Much appreciate your time.
Thank you so much, Neeraj.
All right, and viewers, thanks for tuning into this leg of the Mutual Fund Show.